Hello and welcome to our discussion on preparation of financial statements when the business decisions are given. In our past sessions we saw that every business decision involve financial items, and these financial items find place in the balance sheet, income statement and cash flow statement. But this process of converting the business decisions into financial statements is based on certain accounting assumptions or concepts or principles, and some of them we discussed in our previous sessions. One of them was the accrual concept, which says that both cash and credit transactions should be recorded immediately at the time of the transaction. So it is a recognition principle. So according to accrual principle, the expenses not paid should also be recorded, and expenses not paid is a liability. Example is an outstanding salary. Similarly, income not received should also be recorded, and that is an asset, for example debtor. In the next session we also saw that some more items relating to the accrual concept, like unearned revenue, for example advance from the customer. It's an income received before it becomes due, so it is a liability. In the same way, the prepaid expenses paid before it becomes due, is an asset. During the matching principles session we saw that the revenue for the period should be compared with the corresponding cost to determine the profit. So therefore, profit for the period is the income for the period minus the expenses for the period. Under that we took an example of depreciation, and depreciation can be defined in several ways. One of the commonly accepted definitions of depreciation is the allocation of cost over the life. In this session we'll try to understand bad debt and discount. Before I define it, let us take an example to understand. As usual, we're continuing with a similar set of transactions. Want to understand the effect of them on the balance sheet, on the income statement and the cash flow statement. So started business with cash is a source, and the source is a capital, and the amount is 100,000, and this source is a received, so therefore capital is a receipt and a source. And with that capital they wanted to buy goods, but you can see that you don't have that much of money. You wanted to buy goods worth of 120,000. So let us buy the stock, and you can take a decision that we will acquire the stock on credit, and let us call that creditor, okay, that is 120,000, okay, creditor 120,000. And there is no payment to that because we have decided to buy the goods on credit. Okay, so let me make it black. Buy the goods on credit. Now you have stock of 120,000, and you have capital of 100,000, and you have creditor of 120,000. And with this stock you decide to sell 50% of the goods you sold to X. So we have sales, sold goods 130,000, no cash receipts, but you get Mr. X as a debtor 130,000. This process of recording the credit transaction is because of the accrual concept, which I mentioned in our previous session, where I said if I take you back to this, that the income not received is an asset, and this is an example of income not received, which is an asset. And whenever there is a sale, there has to be cost of goods sold, and 50% of this stock, okay, 50% of that, so 0.50, and cost of goods sold. Why should I show cost of goods sold? Let me again take you back to the principle. We saw that in the matching principle, the matching principle says the revenue should be matched with the corresponding cost. So therefore the revenue here should be matched with the corresponding cost, that is 60,000. And if 60,000 stock has gone down, then the value of this stock on the balance sheet should also come down, Okay, the value of this stock on the balance sheet should also come down to the extent of 60,000. The stock has come down. If you want to see why did the stock come down, you can see that we had a stock of 120, we sold 60,000 worth for 130, so stock has come down. Now you have stock of 60,000 and this stock is sold to Y once again on credit. So my sales goes up to 250,000, no receipt, but you have another person, that is Y, which is on debtor, which is on credit and is called a debtor because of the accrual principle. But because of the matching principle, once again I have to show the balance stock as the cost of goods sold, and the stock will no more be there in the balance sheet because the entire stock is sold. So you can see that how this stock has become zero. You acquired stock of 120,000 on credit and you sold the entire stock, so therefore entire stock is, no stock is visible or available on the balance sheet. Then you paid expenses, so salaries for the period is 20,000 and you paid that salaries, so salaries for the period you paid. Okay, no outstanding because entire salary has been paid. X has become insolvent. X has to pay you 130,000 but could pay only 105,000, so collection from Mr. X 105,000, and because he became insolvent we say the balance money will not be recovered, and the balance money is 130 minus 105, that is 25,000. And therefore let me define that. So bad debt is a loss. Bad debt is a loss due to the insolvency of the debtor. Bad debt is a loss due to the bankruptcy of the debtor. So Mr. X, who is a debtor, will no more appear on the balance sheet as an asset because he paid 105,000 and there is a bad debt of 25,000, so X becomes zero. But in case of Y, if you see, they paid 112 and Y has not become insolvent, so just closes the books of account. So we are giving an incentive to them, and that is called discount. You see the difference? The discount here is 120 minus 112, 120 minus 112, 8,000. So let me first define discount. So discount I'll treat as an expense and bad debt is a loss, but both will reduce the profit for the period. So once again Mr. X will not be there on the balance sheet because X has paid 100, so Y will not be there because Y has paid 112 and the business has given a discount of 8,000, so Y is no more there. So X is not there because of insolvent and bad debt. Y is not there because they paid the money, closed the account, and there is a discount which is an expense. Now all the transactions have been entered, so we'll find out the profits. The profit will be sales minus the expenses, sales minus expenses. So the profit before tax, PBT, is 77,000. So tax is assumed that we'll assume 30%. We can write down here, I did not write, now I'll write down here 30% tax, and let us assume that we pay tax 23,100. And what to do with the profit? Consistency will maintain. The entire profit is retained. Okay, so profit will appear on the balance sheet as a retained profit. Okay, now cash in hand, the total cash receipts is 317,000. Total cash payments, total cash payment is 43,100. So cash in hand is 317 minus 43,000, so 273,900. So cash in hand is 273,900. Okay, 200,900. So cash in hand 273,900 will appear, and the asset side, so tax you paid, so profit is 77 minus 23. So the balance sheet, you can see, is telling 273,900 and 273,000. The focus of this discussion was on a bad debt and discount. So bad debt is a loss, discount is an expense. In one of our future sessions, we'll try to understand that because of the conservative convention, the business is allowed to create some provisions for the bad debt. But at present, we are assuming that the current loss is treated in the balance sheet, in the income statement, in the current year itself. Thank you very much.